looking at here is just the basic trial account to power options. Remember, if you haven't yet, you can take a 14-day free trial at any time. If you've just started out, of course, I do encourage you to take advantage of the 4 steps that are listed there to help you get started quickly. You can access the free quick start guide, go through the various flash tutorials to learn how to use some of the tools. We host a variety of free webinars during the week, and at any time you can access our vast archive of recorded webinars on option strategies, power options tools, management techniques, and more. And of course, any trial or subscriber can sign up for a free coaching session at any time, so you want to make sure you take advantage of that as well. Now, our first question comes in from JD, and JD is just getting started with the RadioActive Trading techniques, limited risk technique with the 12 different income methods. The initial structure of a RadioActive trade is a unique setup of a married put where we put time on our side, guaranteed a low risk, 4, 5, 6, 7%, even in the worst case scenario, and we can manage the position going forward. Now, JD's question is related to some of the 12 income methods that are discussed in the blueprint, the full work that describes the RadioActive trading techniques. And of course, we have our end of the year promotion going on right now with a variety of different bonuses. But the question is, I've opened a couple of RadioActive positions. They're waiting on appreciation to do anything, and that's usually how we start. Now, I gather from other presentations online that income method number 1, selling a call, sort of a covered call or creating a collar, is not favored if upward momentum is still expected. Okay. Now, I believe that income method number 5 is one of the riskless spread trades we use in this technique, is a good move because you can generate a credit and get a higher return. Is this correct? Well, in the blueprint, the chapter on each income method, of course, discusses what we refer to as the SIGA model for a position. What that means is to decide which income method best suits your needs, you want to consider the current conditions of your position and the stock itself, your expectations going forward, your goals for the position, and that will help determine your action. So first, let's just take your first question. Now, I'm just going to go to the basic search for married put, and the default criteria here for the results that come up is the RadioActive default screens that I use to open my own positions in the Fusion portfolio that our investors see, our subscribers there see. So I could take from this list, and the other day, during our RadioActive trading presentation, we took the PayPal example, and I'm going to stick with that for right now. So let's say I was going to open PayPal today at $73.84. Let's open it as a RadioActive trade. At the same time I purchase stock, I'd buy a January, I'd probably go shorter term, but we'll talk about that in a moment. But I might go to the January 77.5 strike at 10.20. I'm going to go shorter term actually in just a moment. Now my total investment would be $84.04, but remember I'm guaranteed to get $77.50 back in the worst case scenario, no matter what. So my true risk is only $6.54 or 7.8%. Now let's take a look at the profit and loss chart for this position. Here's our structure. If I bought 100 shares of stock and bought one January 77.5 strike put for 10.20. Naturally, if I wait all the way to January, make no adjustments to the position, the stock's below 77.50, I'd lose the entire 646, the time value on the put, and have a loss of 7.7, 7.8%. That's not my goal. And as you can see by the curved red line here, even though my cost basis is 83.97 or so into the position, 83.96, at the halfway point on July 9th, I may only need the stock to be trading right around 77.50 or so in order to make a profit, because I'm not down 10, 12, 10, 20 as soon as I open the position, and I'm not down 646. The time decay on this put is going to be very slow, so I'm going to retain most of that. And right now I could liquidate it as soon as I wanted to, as soon as I opened it, and only lose the bid-ask spread. But the question that came in from JD is that, well, if you look to sell a call against the position, and usually I want to wait for the stock to move up, But he mentioned that if you think the stock's going to continue to move up, is selling a call a good idea? Now, first thing, I never do income method number one, selling a call right away. Why? Well, even though the stock offers weekly options, let's go to this January 2018 expiration. And I could sell the 75 call for $1.42, which cancels a little, about, 1/5 of the risk on the position. Of course, I would only sell the 77.50 call, because if I sell a call below the put strike price, I'm going to increase the risk. How does that work? Let's take a look. So I'd sell the 75 call right now. Now remember, when I opened this position, it's because I had an expectation the stock would be trading at or near the put strike price was in the next 20 to 30 days. My cost basis is $83.96 into the position. So if I sell a 75 strike call now for that $1.42, $1.43, I'm going to generate income to lower the risk to the downside. But how did my risk go up to 755 to 9.1%? Well, it's to the upside. Because remember, my cost basis is still $82.55. And I've agreed to potentially give up my shares of stock at 75. So if the stock suddenly had an unexpected gap up to $90, $89 per share, what would happen? My put would decline drastically. Even though it's out to January 2019, it would still lose a lot of value. And I'm not getting any more positive delta on the stock because it's countered by the obligation of the short call. The stock's at 89. Sure, I gained about $15.16 on the stock, but it would cost me $14 to buy to close the call. So I'm not getting a lot of monetary advantage, and my put would probably drop down to $4 or $3 per share. And you can see by the outcome of the risk-reward profile when we sell a call, yes, I generated premium to lower that risk to the downside, but if my expectation is that this stock's going to continue to move up in price, I've now given myself 2 break-evens by January expiration 30 days away. So if I think the stock has the potential to be trading around $78, $79 per share, this is not an adjustment I would use. Now let's backtrack. Okay, let's get a different structure here. Let's say the stock's at $73.84 right now. Let's say that we had gotten into PayPal earlier at around $71 per share. And at that time, instead of the January 77.5 put, let's say a week or so ago or a couple weeks ago when we could get in around 71, I may have bought the July, let's say 75 put, and I probably would have paid around $7.50 for that. Okay, so these aren't real numbers, but let's say I got into the position here and now the stock's moved up to 73.84. All right, so here's a risk. Okay, it probably would have cost a little bit more. Let's put that up to $8.50. Would have been a 6%, 7% risk. Okay, that's good. 5.7% on the position. All right, same structure, but we're using a July put with our 75 strike. Now, let's say that I did this 2 weeks ago. Now the stock's trading at 73.84. If I think it's going to continue to rise, we already showed, even though the stock is closer to my put strike price and I've been in it for a while, that I probably don't want to sell the 75 strike if I think the stock might go to $75.80 or more, or $78.80 or $80 or more. So another adjustment we could use is called income method number 5. It's a ratio call spread, but done in the context of the nested trade, the radioactive trade. It doesn't take on any additional risk. What we look to do is buy a call and sell 2 higher strike calls for a credit. And the 2 higher strike calls that we're selling should be at the target point of our expectation for the stock going forward. So let's go 28 days out again. We have a variety of single strikes here. 260. Okay, so what I might consider doing now is instead of selling the call at 75 and capping the gain, I might buy a 73 call for about 245 or so and sell 2 75s for maybe $1.40 or $1.45. So I'll take in 290, I get a smaller credit, but now I have an interesting advantage. So I'm going to buy one of the 73s. It's usually best to buy at or slightly in the money, and sell twice as many out of the money. Now, this still caps the upside gain, and it still can have a loss further on, but we get an extra bonus on this position. Now, first off, notice that the risk did lower, but not by much, because in this case, we only took in a credit of 41 cents. Why would I do it this way instead of just selling the 75 call and getting $1.43 directly? With this spread done in the proper context, and I'll show you what a ratio spread would normally look like, we don't do it because it carries infinite risk. But if you own the stock, what you've essentially done is a covered call, right? So one of my two calls here at 75 is covered by the stock. And then I have a bull call debit spread added to the position as well. So there's no margin requirement. None of the calls are naked, even though I did a 2-to-1 ratio because I own the stock. So what we're trying to do here is get this benefit. If the stock is trading right around 75, what happens? Well, the two short calls would expire worthless. You keep that small 41-cent net credit, and then we can sell to close the 73 call for, best case scenario, $2. So I essentially get $2.41. I'd lower this risk down now to 209. It would be about 2.6, 2.7% with that one move. So this is a good move, income method number 5, but if it keeps going up, you have a similar issue. Now let's take a look at this. The max profit with this income method number 5, the ratio call spread is $366 or 4.6% if the stock's trading right at 75. We didn't lower the risk by that much, although we did receive a credit. One of the caveats with income method number 5 is I don't want to do it at a debit if possible, and sometimes that's difficult. Same position, if I just sold the January 75 call, we know we're going to take in $1.42 now instead of 41 cents. But if the stock's trading right at 75 now, we don't get that extra benefit of the debit spread. We only make $268. However, we did lower our risk further on the position because of the higher premium. Okay, so it's a trade-off there. What's another problem with income method number 1 by itself? Well, if you think the stock's going to be here or up in this price range, or if it gaps up suddenly against you, you actually have 2 ways to lose again. We saw that before. So that's where the SIGA model comes into play. If you think the stock's going to be trading right around 75 or 74.50, 75.50 per share, income method number 1 is okay. Income method number 5 is also okay in this scenario. It would work out a little bit better monetarily. A caveat with when is income method number 5 not as good as well, if the stock doesn't move up to where we want, stays here at 73 or pulls back to 73, we only got 41 cents instead of the $1.42. So if you think the stock's going to continue up, income method number 5 gives you that extra boost because of the debit spread inside of that nested trade. An extra $2, the difference in the strike prices. You want it to be done at a credit. If you have earnings coming up and you want to generate some income, but you don't want the stock to run up, where your income method number 1 here, selling the call against the married put, or the ratio call spread, income method number 5, caps the gain, that's when you'd probably consider the bear call spread, income method number 6. Even though you're doing a bearish spread, I'm going to go with the 74-76 spread, 2 points apart. But even though I'm entering what would look like a bear call spread by selling the 74 and buying the 76, in the nested trade, this actually comes out to be a bullish position. Because I generate income, and yes, I may be obligated to deliver shares of stock, but if it really gaps up in price, even though my stock might be assigned at 74, the 76 call still gains. So we leave that infinite upside in place. In this case, we generate about 90 cents, 84 cents, 85 cents of net credit. So we did lower our risk, but we left the upside open if it gaps, but we still may be obligated to deliver shares of stock. Remember, when you open any type of spread, whether it's in a nested trade here of a RadioActive Trade or as part of a straight bear call credit spread, bull put credit spread, and so forth, remember that doesn't cancel the obligation. If I sell a call in a bear call spread, I may still be obligated to deliver shares of stock that I don't own, which means I'd end up being short shares of stock. If it does gap up a little above both strikes, I'm okay. That's why you do the bear call. Let's clear these out here. But anytime you do a combination of selling a call or selling a put, either with another call or another put or inside a short stock or long stock position, you don't change the obligation. If I entered this bear call spread on PayPal, and this is not a recommendation or suggestion, but if the stock stays where it is at 73.89, my 76 call expires, I still have an obligation to deliver shares of stock at 74. What my broker would do is essentially short shares of stock for me at that price. Okay, so just because you're in a spread, it doesn't change the obligation of the short position. Okay? All right, so this also leads now, another follow-up to a RadioActive Trade. This comes from Pink Panther. He says, can you help me with an IM number 1? Is there improvement in max risk for the position when it makes sense to sell the call? Is there a rule of thumb? Yes. Okay, let's go back to our main position here, our fake position. Okay, we kind of already covered this a little bit, but let me illustrate it once more. Again, say I got into PayPal at $71, and at the time we had bought the 75 put for about $8.50. And I just added the call, didn't I? Let's take that out. Let's add the 75 put and $8.50. I apologize. So when I first opened the position, I didn't want to sell the 75 call right away. Why? Because the premium would have been too low. And my risk is $4.50. And at the time of the stock at 71, maybe I could have sold the 75 strike January call and gotten 50 cents. But it didn't really reduce my risk much. Okay? When I opened the position, I had the expectation that the stock would move up. My goal is about 3 to 5% in the first 30 days. Okay? Now, if it stagnates, I'll consider doing another income method at the checkpoint, 21, 25 days in. If it falls, I'll do a different income method. But now if it matches my expectation and it moves up, it didn't quite move up 5%, but we gained almost $3 here on the $71 investment there. So we did get it close to 3% or so. Now the 75 call, go at a month, we already saw was at $1.40 or so. All right, so that's a much better premium than the 50 cents, almost 3 times as much. So the rules are described in that chapter of the blueprint, and in general, when selling a call, I want to wait for the stock to move up. I want it to be trading at or near the put strike price, and at the same time, oh, sorry, let me go ahead and submit this. I thought I already did that there, PP. There we go. All right. But at the same time, if I sell the call, sure, I reduce the risk. Took it from, in this case, 5.7% down to 3.9. Decent gain for, if it maxes out at the max gain, right at the short call strike price, which is why it's always important to graph the position. I'll illustrate that in a moment. But I'm sorry, trading right at the short call strike price is the max return of 3.4%. Not a bad return for, in this case, we'd say about 45 days. We're saying we've been in this for about 2 weeks or so. But I'm not going to plan on liquidating the position at that time for 3.4. I'd continue to manage it and adjust it. Now, when is it a bad idea to sell a call? When is it a bad idea to sell the call in this case? Okay, well, it's a bad idea to sell the call if my expectation was the stock was going to go up to 78, 79, 80 or higher based on its current trend. I don't want to be in this position. Yes, it lowered the risk, but I want something that gives me unlimited upside and continues it. Okay? So if you have earnings coming up, that's not a good time to sell the call because you can give yourself 2 ways to lose. All right? And all of that's discussed in the blueprint as well. When to do it, why to do it, and how to do it. Earlier today, I had a conversation with a gentleman. He bought the blueprint a few years ago. and he's just getting back into it now. And I just forgot the stock. I can't remember what the name of the stock was, shoot. But the example was he had gotten into the stock at about $46, $47, and he had bought a 55 put. Let me go back to the search. It was one of the ones he had here. It was on the list. My apologies here. I'm going to take this one. I'm going to take Winnebago, 56.25. Okay, so WGO. Let me go back to the custom spread tool. Anyway, the structure was similar to this, but a little bit different. So we see that this position here is at 56.45. We'll say that he got in at 54. The numbers are slightly different. Okay, and went out to July. Actually, his was January, but he went to the 65 put. He's about 20% in the money, right around the range, the maximum range I'd look to go in the money with the put. Anything beyond that, I'm hedging it out too much. Let me increase this to 1405. So he went deeper in the money and he had a lower risk. That's about right. It's about a 4% risk, 4.5% risk. Sorry, let me just drop this down to 1350. Okay. So we're at a risk of about 4%. 65 put on Winnebago, stock's trading at 56. So what he was interested at, he looked at January, and he was going to sell the 60 call. He was going to sell a call below the put strike price. Now his was actually worse. He had a 55 put on a $46 stock, and he wanted to sell the 47 call. Remember, my cost basis is $67.50. If I sell the 60 call here for 60 cents right now just because it's available, what do we see? We increase the risk to 10.3%. Not on the downside. We did lower the downside risk by 60 cents or so, but remember, our cost into the total position is still $66.90, and we've entered an obligation to deliver shares at 60. So if it gaps up in price for an unexpected reason, the put's declining, we get no further gain on the stock beyond 60, short call delta will go to 1 quickly if the stock's at 70 or so. So as the stock continues to move up, we're losing money on the put. As I always say in a situation like this, when someone says, well, the stock's moved up, should I roll the put? No, if you have a call sold, always adjust the call first, worry about the put afterwards. This is what's losing you money in these scenarios. Not the put, it's the call. If your call goes in the money, if the stock goes above this price to 63, 64, or 65, you might say, well, the stock's trading at 65, I should roll the put. No, always adjust the call first, because that's what's losing you the most money. The short call is going to a delta of 1 as it goes deeper in the money. So for every dollar the stock gains, you're losing more on the short call. Okay? Not the put. That's the issue. All right, so that's just sort of the concept there of when to sell it. Well, I never sell a call below the put strike price if I can avoid it. I want to sell it when the stock is near the put strike price, and even if I do that, it's because I think the stock has maybe reached its peak and is going to stay the same or pull back a little bit. Reread the chapter on income method number 1. It walks through why you want to sell, what call you want to sell, what premium you want to look for. When I sell a call, I want to reduce this premium by at least about 1/3 to 1/2 if possible. If I'm using weeklies, you can go to 1/4, maybe 1/5. But you want to make sure the premium you're getting is worthwhile, that you're not selling calls for the sake of selling calls. And again, why wouldn't we sell the 65 call in this case on WGO? Because that's our put strike price. Well, it's because there's no premium. We'll get 10 cents. I might as well just leave the position alone, wait for it to move up, try to get at least more than that as well. Excuse me, folks. All right. John's going in depth here into a question related to when deciding which put to choose, would purchasing a leap 1 to 2 years out give you more time to manage your position? Yes, it does, but it also costs more. Let me go back to my analysis on PayPal. Now, we saw that with PayPal, if I bought it right now today at $73.89, we could have bought the January 19, 77.5 put for about 10.10. Now it'd be closer to 10.15, 10.20. Okay, so that's the January 19, and that was 392 days out in time. Now, that's not our risk, that's the cost, but our put is about $4 in the money here, so our risk is only about that $600 we saw. Going out to January 2020 is 756 days out in time, pretty much double. But the 77.50 put is only trading at 12.60 or so. I'm sorry, the 13.10. All right, so it's cost you $3 more to purchase this put against the stock, which would take the risk up to, whoops, did that in reverse, I apologize. Let's get our stock in there. Got our put in there, 13.13. So now the risk's up to 952 or 10.9%, but for 2 years of protection. Okay, what is the advantage of doing this? Remember, the January 2019 option, this is the 2020, right? Yeah, the 2019 77.5 was priced at 10.10. Okay, well that's all well and good. It would have had a risk of about $600 or so. The 2-year out leap is at 13.12. We see we have a risk of 10.9% for double the time. Is the put option double the cost? No. Is the risk double the risk? No. Okay, it's not, the option that's 6 months out in time will not be 6 times the cost of the near term. That's why we always say when you buy further out in time, you get a lower cost per day. What is the advantage of going 2 years out in time and putting this much money into this position? Well, other than the fact that you have only about a 5.4% risk for a total of 2 years, and you've got roughly 24 months to make adjustments on the position, 24 right cycles or more if there's weeklies, you do have another management opportunity that exists here that doesn't exist if you only go 5 or 6 months out in time. So let's say in the first 20 days to January expiration, January 2018 expiration, PayPal stays at $73.89. It doesn't move. Well, I'm going to see some loss, some time value decay on this position, but not a lot. Let me see if the Black-Scholes model will give us a good answer. Let's say it stays there, but on January 19th, I believe it is, we stay right at 73.89. Well, this actually increased because of it. That wouldn't be realistic, so let me put a volatility at 0.24. That's probably way too much. All right, in any case, let's say that I lose $1 in time value, which is not going to happen because it's $9.52 of time premium for 48 months. So I might only lose 40 or 50 cents. But in any case, let's say that we did lose some money here. Let's say we lost 50 cents and the price of our 2-year out 77.5 put dropped down to 12.63. Well, what else decayed? All the other put options because time went by. So if I lost another 60 cents on our January 2018 and would now be priced at 950, or let's call it 980, consider this. What I could do is that it's not doing what I wanted in the first 30 days. It hasn't moved. I could maybe sell that 77.5 put, take a small loss, but then buy the January put. And we're going to put in our price. We're going to say we lost 50 cents here, so we'd sell this for about $12.60 or $12.65. I'll put it at $12.60. And then we're going to roll it into the closer one at the same strike. But let's say this dropped a little bit and is priced at $9.80. It also dropped 50 cents from the 10.10. Or really, I only have it 30 cents down at the 10.10 from where it was. So 30 days from now, the stock's still trading at $73.89. Volatility remained the same. Remember, our original risk on the position was 10.9%. I can move this in, still have 365 days, but in 30 days I've reduced my risk by 2%. I've lowered my total cost in the position by 2% and kept the insurance there as well. So going 2 years out does give you an opportunity. It gives you two things. It gives you an opportunity to, if in the first 30 to 60 days the stock's not doing what you want, you can roll it in almost a full year, still have 300 days of insurance in place, and maybe reduce the risk by 1 or 2% from your original position. If I bought the January 2019, the same thing happened. I could probably roll it into the July. Now I'm only looking at 150, 160 days out of insurance, but I could lower the risk that way too. Okay. The other thing it gives you is a lower cost per insurance per day. Going out 2 years out of time did not double the risk or double the cost of buying the 1 year out option. That's not how options work. Okay, it's not a linear increase for time. So you have a lower cost per day, a lower risk per day. What's the problem? Well, you're paying more up front to get in the position, $200, $300, $400 more to get in the position. So monetarily, you're paying more up front. And your break-even increases, but remember that break-even is only at expiration, which is 700 some odd days away, 750 days away. Okay, so that's kind of what we talk about there. Is there an advantage? Well, based on how long you want to stay in the position, a benefit of going 2 years out in time is in the first 60 days, you can even roll that in and maybe lower your risk by 1% or 2%, even if the stock hasn't moved at all. You have much more right cycles available, and you did not increase the risk. But, you know, we have to analyze this as a, what do you call that, a 5.45% risk for 365 days. This is 750 days out, and that's more than acceptable in this case. All right. Moving on now. David says, let me just break there for a moment, check something here. Okay, hold on one second. Why is this? This is a question from Paul on the profit and loss chart. Let's go back to our position. Let me make sure I've got everything set here. Here's that initial married put I talked about with the expiration date out to 2020. And Paul says, why is this coming up as 1/7/2019? That's the halfway point between today and 2020 expiration. Okay? That's what we're looking at there. All right, so that's why anytime you enter, if I opened a January covered call right now for January 2018, this would show a midpoint of 1/7/2018 because that's the halfway point between now, okay, 1/14. I apologize, but the halfway point between now and January 2018 expiration. That's what it comes up to as the default. I'm at the halfway point. So I scrolled up to go nearer term, but it automatically defaulted to the halfway point of 1/7/2019 with the put out to 2020. Right? So it always defaults to the halfway point in that scenario, Paul. Okay? All right. Let me just read this question first. Okay, so this is a question that comes up consistently. We're staying with the radioactive trading concepts here, but we're going to go back into actual setup. Okay? And David's question is that he trades radioactive almost exclusively. He trades small, one put with 100 shares. Right now, because he's only using smaller amounts, he's not using open interest as a consideration in his criteria. Now, someday he says, I want to trade larger, where the open interest would become more critical in my selection. Could you give me a general rule or guideline as to what percentage my entry position should be of the total open interest figure? For example, if the open interest 100, should I trade no more than 10 puts or 10% of the open interest? I don't think that's relevant as far as percentage goes. I do actually look at the hard number, but I'm not trading thousands of shares for each of my married puts. Most of them are 100 or 200 or maybe 500 shares. So in general, I want the open interest to be equal to at least half or double the amount of shares I'm planning on trading. If the most I would do is 500 shares, I'd start off with an open interest of 10. So in reality, I'd say 50%, not 10%. And it's still a good rule of thumb, because remember, you're not going to see as much activity farther out in time as you see with the weeklies, near term, or the monthlies. but a good reasonable open interest of 10, 12, 15 contracts, 10 contracts or more, if you're only going to be trading 500 shares or 300 shares, I think that's a good number. I don't think I need it to be 10 times the amount of open interest I'm trading. There will be liquidity there. We know there's lower volume with the puts that we're buying because they're further out in time, but hey, there's always a market for them. I'd say 97% of the time I get filled at the midpoint within 5 minutes of entering it when I enter a radioactive trade. Only a few times it happened where I had to fight the market maker and got, or the market maker was driving me to a much lower deal than I wanted to pay, or driving me up, I should say, than I wanted to pay in that case. But as a general rule, I'd say start with an open interest of 10. If you're going to start allocating a lot more funds to radioactive trading, David, and you feel that each position that you open is going to be 1,000 shares, and you'll be opening 10 contracts, I'd double this to 20. You might not find a lot of positions. Let's see. I'll go ahead and go 20. All right, still good. Freeport, PayPal, Grubhub, Domino's, Winnebago again, Toll Brothers, T-Mobile, VMware, good list of stocks there for radioactive trade. Okay, so I would say double the average is what you're kind of looking for. 50% if you wanted a percentage number instead of looking at that 10% value. You know, maybe just 50%. If that makes sense. So yeah, if now you were saying that if you did 100 contracts, I think, would you want an open interest of 10? No. You wouldn't do that. If you're going to do, 10,000 shares and 100 contracts, you'd want an open interest of 200. But if you're planning on opening 1,000 shares and doing 10 contracts, I think looking for an open interest of 20 or greater is just fine, and you'll still have a very liquid market for the position. Okay. I don't think you need 100 open interest if you're planning on trading 10 contracts. That couldn't hurt. Let's see if any of these have that. Oh, is this the 20 or is this the 10? Oh, this is the 20. Let me go back to the 10 open interest here, assuming that the max I'd open was 500 and 5 puts. Let's go into choose columns so I can customize the search in any strategy. And I want open interest. Did I just pass it? Yeah, option open interest. I'm going to add that to my columns. It's going to ask me to resend it. It's going to add it to the end. Yeah, but see here, that's not a good view. Let me reorder. I'm going to reorder so it's easier for everyone to view. Sorry about that. Let's go back into see more or less columns. I'm going to change the column order. Let's move open interest up to the next to the maximum risk percentage. Here we go. All right. So I looked for a minimum of 10, and look at these FCX 130. That's better. Now we can see the symbols, but FCX at a 130 open interest, IIVI at 19, 16 for Domino's, 11 for Ollie's Bargain Outlets, 13 for Centene, and so forth. But most of these, 771 for VMware, 218 for T-Mobile. That's out to January 2018, 390 days away. 166 for the Winnebago one. So there's still good volume to be found, good liquidity to be found. But again, if you're planning on opening, 1,000 shares and 10 contracts, I may look for a minimum open interest of 20, double what you plan on opening. Okay? I don't think you need an open interest of 100 minimum if you're planning on opening 10 contracts. I think double is still a good liquidity measure for something that's this far out in time as well. Okay. Let's see here. Now we're going to switch strategies. We've been talking about married puts. We covered a lot of information. Sheldon, before I go to that, I'm just going to remind everyone the discussions that we're having, of course, about the married put, the 12 different income methods, when and how to use them is all described in the blueprint. Remember, our end of year special is going on right now tonight, so you get 8 bonuses if you pick up the blueprint between now and December 31st. So you get 2 months of the Fusion subscription for only $10. You get a free month of Power Options. We're offering 2 of the Mastery Series videos if you pick up the blueprint. Foundations of Radioactive Trading video, and of course, the new one I'm going to put out in January, the Income Method number 12 Mastery Series video as well. Of course, you get free email support, also free shipping with the bonus, and at the same time, You also get the money back guarantee. The full technique of what we're talking about there is in the blueprints. It's the only place. You go to radioactivetrading.com/EOY to check out the special bonus offer. And I'm just going to send that to everyone in the chat window. The specific link there is radioactivetrading.com/EOY. Okay, now, switching strategies. We've been talking about protective position, the income methods. Sheldon wants to talk about naked puts, cash secured naked puts. What are your suggestions on selling naked puts and rules for getting in and out? Before I go over a review, Sheldon, I want to remind you at any time, go to our free webinars page, powerup.com/webinars.asp, right up here at the top. Send that to everyone also. Okay. You don't need to be a subscriber. You don't need to be on a trial. This is a public page. You can access it at any time. In the option strategy section, if you have time later on this weekend, in the option strategy, you see managing your spread positions, debit spreads versus credit spreads, calendar spreads, and so on. Further down the list, there we go. January 2015 and February 2015 was our series on Introduction to Naked Puts. This webinar, the basic actions and setup, discuss terms used by naked put investors, tips on researching and analyzing, criteria to look for, standard versus weekly, and review of management techniques. And there's a full webinar here on the management techniques as well, different ways you could manage cash secured naked put position. All right, now that's what I want you to check out later on, Sheldon, when we go, if you have time over the weekend. But let's review real quick. Naked put is when you sell a put which obligates you to potentially buy shares of stock at a set price. You generate a premium. A lot of investors say, well, I'd never trade a naked put. That's one of the riskiest things you can do. It is a parity trade with the exact same risk-reward profile to a covered call. It pretty much carries an out-of-the-money put. So let's say my stock is trading here at 50. I sell an out-of-the-money 47.5 put for maybe 50 cents or so, and the risk is to the downside if the stock falls. And investors say, well, I would never do that. It's the riskiest thing you could do. Now, selling a naked call is technically the riskiest thing you could do. The opposite, that has infinite risk to the upside. But the naked put has the exact same risk-reward profile as a covered call. It's no safer. It's no riskier than a covered call. Now, a naked put at 20% margin might be considered riskier than a covered call where you bought the stock not being on margin. We could argue that. But as a basic structure, naked put has the exact same risk-reward profile as a covered call. So let's say our stock's at 50. I buy stock at 50. I sell an in-the-money 47.5 call for $3. Okay, so I get $3 up front. My break-even becomes 47. And if the stock's above 50, I get the max return of 50 cents. That's the exact same risk-reward profile by selling the 47.5 put. I got 50 cents, so my break-even is at 47. And if the stock stays above 50 or anywhere above 47.5, just like in the covered call, instead of getting assigned, the put expires, I keep the premium. The stock falls to 47, I may be forced to buy shares of stock at 47.50, but my true cost is 47. So they're parity trades. Now, Sheldon's question, what are your suggestions for selling naked puts and a rule for getting in and out? Number one rule for selling naked puts, only sell naked puts on stocks that you would not mind owning long term. Why? Because that's a potential outcome of this position. Don't trade naked puts looking for the highest premium on the most volatile stocks. Premium's high for a reason. The implied volatility is high for a reason. This stock could swing against you quickly, so I might get into, let's say, YY. I don't know much about that stock at all, but let's take a look here at the profit and loss chart. It has a pretty high yield, and we're looking at a full 30-day out time period. But let's say this is double of most of the premiums that we saw. So I'm selling an out-of-the-money 107 put for 240. My break even is 104.60. The stock's at 114. So I essentially have 10 points, about 10% movement, 8.9%, to get to break even, until I start losing money. What could go wrong? Well, if this is inflated because earnings are coming up on January 10th, and on January 10th the earnings disappoint and the stock drops 20% down to $84. I'm sorry, $84. Here we go. That's better. A little bit more than 20%. Let's say it drops down to $84. It's really about 30%. But let's say it drops down to that price. I'm going to be forced to buy shares of stock at 107. I'm probably going to get assigned early. So I still have a significant loss. Same thing would happen if I opened a covered call and bought the stock today at 114.60 and sold the 107 call, and the stock gap down to 84. But don't follow the trend. In other words, don't look for the premium that's 4 or 5 or 6% when all of the 38-day out options are only offering a yield, what we call the percent naked yield, of 3.6, 2.0, 1.7, and so forth. I could find naked puts that are 30 days out in time that would give me a 5, 6, 7% naked yield and still be 10, 15% out of the money. But that is an event coming up that could cause the stock to swing wildly, and that's not what I want to be in a directional position, meaning a bull put spread, a bull call debit spread, a covered call, or a naked put. Those aren't the best strategies to go through in earnings, okay? All right, now, so rule of thumb number 1, only trade positions on stocks that you would not mind owning long term. Range out of the money, what should you look for? Well, it's what you're comfortable with, okay? You see our default search here is going about 6% out of the money or more, and you see about a 1, 2% yield we saw for about a 30-day trade. These are all standard expirations, okay? So, I mean, for me, a naked put should, 30-day position generating income, I'm going to look for at least a 1, 1.5, 2% yield, and this is based on being totally cash secured. So if I was selling that 107 put on YY, if I did one contract, I personally would put up the full $10,700 on the position. Margin requirement on hold in my account in case the stock did fall and I had to buy the shares. I don't want to do it on margin, risk getting a margin call or having margin fees. I'm going to do it as a total cash secured put to be safe. Okay? Does it matter if you do dividend paying stocks or not? Well, remember, you don't get the dividend when you sell a naked put. I'd rather probably see you do a covered call slightly in the money or at the money on a dividend paying stock, so you still take advantage of the dividend rather than doing a naked put. But you want a neutral to bullish stock. Personally, I'm going to use the same stock criteria, technicals and fundamentals, that I would look for if I was buying a stock or entering a covered call. I'm going to want to see a stock with good liquidity, in an uptrend, likely with a positive earnings per share growth to show good management. I'm going to avoid earnings between now and expiration. It's not on this one, but I would avoid earnings between now and expiration because I don't want any surprises. The range out of the money is dictated by what are your goals. I can't answer that for you, Sheldon. We've had this conversation before, and I'm not saying that you didn't get that, but you know where I'm coming from. Jamie might be on the webinar today. I'm not going to look at the attendee list, but Jimmy might be on the webinar, and his goal for 30-day cash-secured naked puts or covered calls is 3% or higher. Well, he's got to change his criteria. He's got to go less out of the money to maybe only 4% out of the money, okay, and look for a minimum percent naked yield of 3% if that's his goals. But again, I'm going to make sure that I avoid earnings between now and expiration. I'm going to look for stocks with positive growth. I might even look specifically for mid-cap stocks or stocks that have a good average volume in addition to being in an uptrend because it's a neutral to bullish position. Okay? There's nothing there. There's no stocks that have at least a 3% naked yield, no married put positions, 4% out of the money that do not have earnings between now and expiration. That's tough. For 1 month. I'm just going 1 month. Bet you if I take that out, I'll find a lot. Oh, I'm sorry, it's ex-dividend date. I meant earnings. But let me take the earnings out. Wow, there's still none. That kind of gives you the volatility gauge. Let me take out the volatility restriction. All right. Nothing, huh? Unbelievable. Let's go to 2.5. Oh, I did go to mid to large cap too. What? No, positions will have a positive earnings per share growth. That's not holding it back. The market cap should be perfectly fine. That's just looking for mid to large cap stocks. Wow. All right, so 4% out of the money or more. Stock's in an uptrend. It's got to be that earnings per share growth. I can't believe it. Let's go 0. So those other positions we see that did offer that return have a negative earnings per share growth. Man, that's kind of tough, isn't it? That's kind of really tough. All right, let's take that out entirely. Unbelievable. Yeah, so here's 3. There's YY again, FA and H. These have a negative earnings per share growth. They've grown and lost money last year to this year with the earnings expectations. So that's not very good as well. I mean, that's not a good thing to see. But I'd want to look for those positions that have good earnings per share growth, positive earnings per share. The same thing I'd look for in a covered call, standard collar, even my married puts. I'd want a stock in an uptrend. The balance, let's take everything out. And let's just go 2 weeks out in time. Okay, so I'm going to go all expirations, and I'm going to go 8 to 17 days out in time. So I'm going to look for 2 weeks. Now I'm going to put my naked yield down to 0.5%, Sheldon, because I'm going shorter term. Where I'd usually want at least 1% for a 30-day trade, I'm going to keep it at 0.5. And I'm going to want to be at least 2% out of the money. Or I could even set the percent break even to be at least 3% or more. Meaning how far can the stock fall before I'd start losing money. Actually, I'm going to leave that at 2 also. And option bid price, I want to receive at least 20 cents in premium. All right. Might put in some liquidity, option volume, and open interest we already talked about. What else? Technicals, average stock volume, maybe at least 750,000 shares on average per day. This is measured in thousands. I want to see good liquidity. And I want to see a stock trading above its 20-day moving average. I want to see that because I'm using a 14-day trade. And I would put maybe MACD in mine as well, but let's keep it simple as we can. Stock price. Is stock price relevant? Well, if you're planning on being totally cash secured with your naked puts like I am because I don't use margin, then the same restriction I have here, I'm sorry, I go 5, would be the same restriction I have with doing a married put. Based on my account size, I'm typically not entering stocks that are above $85 per share. Okay, you could go whatever price you wanted to, and if you're using margin, then you wouldn't worry about this. I'm going to look for positions that don't have earnings between now and expiration. I want to try earnings per share growth greater than 0 again. Let me submit that. This is a shorter term trade. Good. Overstock, Weight Watchers, Tenet, U.S. Steel, Twitter. I wouldn't trade that one. U.S. Steel again, Urban Outfitters, American Airlines, Mosaic. These are mostly water cooler stocks. Stocks you'd hear discussed around the water cooler at work. I think this is a good stock list. Okay. So let's just take Overstock. Why is it in here several times? Well, because in the weeklies it offers $1.50 strike differences. So both the 59.5, the 60, and the 61 all match my criteria. Let me choose the columns again. This is a little bit robust from other webinars that we've had. And I'm just going to go to the default columns. So we're only looking at the basics that we see for the naked put. All right. The same criteria are here. So there's my Overstock. Now, why would I choose one over the other? Well, it's based on what your expectation is for the stock. The stock's at 65.75. The 61 put is good range out of the money and is offering a 3.5% yield. The 59.5 also offer a good premium, also a 3% yield. Both of them are 64, 67, 68% probability above. They have high implied volatility. I'd want to know why. I don't know that right now. These are a higher, look at it. It's almost double everything else in there. Why? There's something going on with Overstock. Either they just had earnings or not related to earnings, or someone's talking about doing it. Of course, they had a big decline today, or relative decline today of $1.70. But when you see something like that, where your top 3 results are double pretty much what the average other positions are, even ones near the same, oh, there's nothing there near the same stock price, it's overstock again. There's a reason why this implied volatility is higher. I want to know why. What happened recently in overstock that caused this implied volatility to be double what everything else is? Something's going on there. I want to know why before I make that trade. But let's throw that out the window. Let's throw the fact that these are double, that these are inflated for some reason. Which is the better put to sell if I decided to sell an overstock? Is it the 61, the 60, or the 59.5? Or further down, the 53? All right. Maybe now we're splitting it. This one gives you the best probability and best break even. It's only 45 cents and a 0.8% yield, which still matches my goals for 14 days. But here you're kind of splitting hairs. All right. And what I mean by that is that the 61, the 60, or the 59.5 better? Well, it's going to depend on what your outlook is for the position, what you're comfortable with the break even, and how comfortable you are with the stock. These are all pretty good. I'll tell you the truth, 9 times out of 10, if I see 3 trades on the same stock that match my goals, I usually go with the middle one. A little bit more out of the money, a little bit higher premium, a little bit higher return, a little bit lower percent to break even. I'll go mid-range. After I've looked at the stock chart, the company information, I can tell you right now I'm probably not trading overstock because it's inflated for a reason. Something's going on. I don't know what it is. I can find out quickly with the links as well. Yeah, Sheldon's, of course, yeah, Bitcoin, the Bitcoin relation and overstock, that's why the volatility has increased. So might be something I'd avoid and take a nice little 62, 63% probability, 2.2% gain on Weight Watchers, or Tenet Healthcare. If I decide I like the stock, I might do that one. Okay, so do it on a stock that you would like to own, or I'm sorry, wouldn't mind owning long term, because that's a potential outcome. Let's just take Weight Watchers. I take Weight Watchers. I sell the 49 strike put on a 50-52 stock. $1.43. I'd probably actually look for a better probability here on this. I'm going to be honest with you. I'm going to increase the probability. I'm going to start it almost the same as my bull put credit spreads. We're going to start at 70. So I want a 70% probability above or more. And yeah, overstock still is there, but now X US Steel. Stock at 35, selling the 33.5 strike for a 0.9 gain. That I like. That gives me a little bit more comfortability, a little bit better to break even. Now this is a 14-day trade. 1.1% yield is good for a 14-day trade, or even 0.9%. Now I sold the 33.5 put, so if US Steel falls below 33.50, I may be forced to buy shares of stock. Now, that brings up the case for the trigger points. So, selection. 1, use the same criteria and look for stocks that you would not mind owning or you'd consider buying right now. Number 2, as far as return, for 14 days, maybe look for 0.5 to 1%. That's going to be in a good volatility range. For 30 days, you're talking maybe 1 to 1.5% to maybe 2%. That's an average yield based on where the volatility is now, the average volatility across the market. Okay? Number 3, you want a stock in an uptrend. You want to look for good fundamentals and technicals, the same criteria you'd use if you were buying a stock right now. You want a good percent probability of around maybe 65 or greater, because I mean, if you're selling a put on a stock you wouldn't mind owning, you look for a probability of 65%. If the stock falls and you're put to stock, hey, that's okay. You didn't mind owning the stock to begin with. Look for good probability, liquidity on the stock and the option. We looked at some of those as well. And number 5, of course, avoid earnings. Now, here I am in US Steel. Even though I might not mind owning this stock at 33.50, I'm getting 36 cents. So really my break even is 33.14. That'd be my cost base if I was forced to buy shares of stock. But in this scenario, I may still look to adjust the position if the stock reaches within 1% of my strike price. So if the stock dropped down to 33.85 or 33.90, I may consider rolling down the put, buying to close the put if it results in a small profit. That might be a trigger point for me. Number 2, Remember I said I was looking in an uptrend, and I may look for MACD. Okay, well, if I'm using any of those technicals and fundamentals as a means to get in my stock, those should also be used as potential triggers. If the stock now drops below its 20-day moving average and changes direction, I might look to roll, adjust, or close this position because it's starting to look like it's going to move against me. That's another trigger point. Number 3, if bad news comes out, well, you might miss it. This might automatically gap down to 33. We are now in the money, but you might consider rolling it at that point to avoid early assignments. So any bad news or anything comes out between now, unfortunately, we're only 14 days out, so it's a shorter time frame. What are the management techniques? Well, that's discussed more in detail in that webinar I mentioned. Now, if it's just a small decline, you could potentially just allow the stock to be put to you and then convert it to a covered call. You're still bullish long term on this position maybe, so just convert it to a covered call, generate premium, lower your cost basis. You can roll down the put. Remember, the risk of rolling down the put is the same as rolling down a covered call. If the stock continues to fall, you're just going to a different loss and then a different loss and then a different loss, and you're going the wrong direction. Trying to catch the falling knife, standing in the way of the train, whatever analogy you want to use. Number 3, I could buy potentially an in-the-money put and create a bear put debit spread if the stock starts to reverse. It may be profitable, it may not be, but you could hedge the loss by buying it in the money put to create a bear put debit spread if the stock is reversing against you. You could just do the reverse, buy to close your put, and then buy another put and just have a long put if the stock continues to go down. That's all discussed in the Managing Naked Put webinar that I discussed. Now, sometimes you can't control things. This stock may gap down immediately for an unexpected event and drop down to $31 per share. Okay, so I'd be put the stock with a cost basis of $33.15. Well, let's say it drops to $30.15, so I'm down about 10%. It's a sudden gap down. I get assigned early. The stock's lower. Now, if with the stock at $30.15, I'm likely not going to be able to sell a 31 or 32 call and get any real premium to help me lower the cost basis. I'm not going to be able to sell the 30 because now if I get assigned, I'll be assigned at a loss and lock in those $3. But that webinar I discussed, Managing Your Naked Puts, it'll discuss other ideas that if you get put the stock because of a sudden gap down, you might be able to use our stock repair tool. Put in your cost basis for the stock, see if there's a ratio call that could get you back to break even. You may average down by another 100 shares of stock at 30, so now your average cost basis is $31.50 or $31.70 from where you got put the stock at $33.50, and buy another 100 shares at 30, you average down, then do the stock repair and see if you can repair the position. Or you may even be able to convert to a covered call and sell the 32 covered call or 32 call against your shares now and still make a return. So Managing Your Naked Put positions in the option strategies section, powerup.com/webinars.asp, February 4th, 2015. Yes, it's about 2 years old, almost 3 years old, but it's the exact same content I would teach today if I was teaching another live webinar this afternoon on Managing Your Naked Put positions. We'd use more modern examples, but that's the same thing. Okay? All right. Arvind had asked a question and he left, so I'm going to try to I guess he had to go there, but it was in relation to a sort of marketing idea that I'm not clear on. He was asking if he could get this information for $10 a month. I don't know if he meant power options or the education, but I'll clarify that with him later as well. All right, well, ladies and gentlemen, I actually don't see any other questions coming in. It's about 5:40 Eastern Time. So we're just about at the end anyway. If anyone does have any last-minute questions, I'll encourage you to send those in now. Oh, sorry, but I'll just jump back in here and go back to the slides, of course. Made a slight mistake here. So, of course, if you do have any other questions that you just thought of or that you didn't get to ask, go ahead and ask those now. I just want to remind everyone, of course, if you haven't done so yet, You could go to powerop.com, put in your name and email address, and you'll have access to the tools for 14 days. And then, of course, after the 14-day trial, we do offer different levels of subscription. Our end-of-day service, where the data is only updated once at the end of the day, is $40 per month. You probably at least want to go with the 20-minute delayed service, where you can do those searches and find the positions that match your specific criteria with only a small delay. That's only $60 per month. Of course, we do offer a real-time, and you can upgrade to the historical service. The delayed plus historical is $100 per month, and that'll give you access to the historical backtest tools, the historical chains, and more. And the historical data goes back to April of 2006 right now. Other free stuff available. Remember, check out the blog. Go to blog.powerop.com. And of course, remember, we've got different blogs there. You remember the webinars page, a lot of information there, powerop.com/webinars.asp. You can also check us out on YouTube. If you do think of a question later on, I know most of us are going to be occupied tomorrow, for example, and Sunday is Christmas Eve, and then Monday is Christmas. But if you have a question, remember, you can email me at any time to support@powerop.com. You can also send us to support@radioactivetrading.com, and remember, you can always reach us at market hours at 877-992-7971. Just a reminder again, one more time here, of course, that the end-of-year promotion is going on for the blueprint. You can check out the store at radioactivetrading.com, or you can go to that link I sent you, radioactivetrading.com/EOY. The blueprint is a full physical product, 250 pages of valuable information on limiting your risk, how to fight your fear and embrace the greed going into 2018. The book contains the initial structure we looked at a little bit today, how to properly set it up. There is such a thing as taking on too little risk. You want to be in the right spot, and then when and how to apply the 12 different income methods, and of course, combine the income methods. There's different ways where I could do a 1 and a 3 together, or 1 and a 5, 1 and a 6, for example, something along those lines, a 4 and a 1, or a 4 and a 2, and so forth. The blueprint is $339, but again, with all the bonuses you get, the first 2 months of Fusion, the RadioActive Trading subscription, where you can follow Ernie's and my trades, see which positions we'd be opening in the RPM report, timed lessons, and more. You get your first 2 months of Fusion for only $10 per month. It's usually $69 per month, so you get a $59 off for the first 2 months. As I mentioned, 2 of those Mastery Series videos and another video will be sent to you as part of the bonuses. You'll get a free month of Power Options that we were looking at today. We'll send you a quick start guide to help you get started sooner. You always have free email support as a Blueprint owner. You get access to our members-only webinars, and we'll have more of those coming up next year in 2018. Normally, since this is a physical product, we charge shipping, but at the end of the year promotion, we're waiving shipping, so you won't have to pay any shipping charge, just $339, and that's the bottom line. No shipping. All the other bonuses are yours as well. By the way, the blueprint does come with a money-back guarantee. So if you pick it up before December 31st, take advantage of all these bonuses. You get to keep the bonuses, but if you decide to send it back, we'll refund your money, no questions asked. So it's a money-back guarantee, no shipping, with all the bonuses there included, free email and phone support, and more. Now, Bruce asked a question when we are back on one of our other screens here looking at the subscriptions there. The premium service here, which gets the API, the programmer's interface is what that is, the a programmer's interface. So what the API allows you to do is, if you know a computer programmer or you're savvy with computer program yourself, you can write scripts to interact with the chain and the Power Options data, I should say, not the chain, but the Power Options data, so you can actually query it and load it into your own file if you want to use like an Excel spreadsheet or anything like that. The API is only available on the premium level of service, which is $160 per month. I don't think right now that history is available through the API. Just standard search queries, chain queries, database queries, and so forth are available, so you can have it into your own display that you want to customize beyond what you can already customize in Power Options. But that's what the API is. It's the programmer's interface, so you can write a computer program to interact with our data and see the results spit out in a format that you want or that you prefer as well. So that's the API. And if you go to the sitemap on Power Options, just on the sitemap, run a search for API, and you'll be able to see the two different articles there that discuss the API, what's available, coding format, and so forth as well. All right. Well, ladies and gentlemen, thank you again for joining me this afternoon. Take a break. Relax. Have a fantastic weekend. Have a very Merry Christmas. And happy holidays. Spend some quality time with your family, with your friends. Again, take a breather and relax. Shortened week next week. Markets closed on Monday again, of course. We know why. So we'll have a 4-day week next week, then a 4-day week the following week after New Year's. I'll let you know when this webinar is archived. I did record it. We'll let you know when it's posted. You can review the materials for the radioactive trading techniques, the naked puts that Sheldon mentioned, and the other management techniques we discussed. You can review that at your convenience. I hope to see you all soon next week for our other live webinars coming up. And happy trading, everyone. Merry Christmas. Happy holidays. We'll see you.